Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. Today we're diving into a report from Snap, the company behind Snapchat. And let me tell you, this report is like a roller coaster full of debt, buybacks, and maybe a little bit of hope. In a nutshell, Snap borrowed a bunch of money, used a lot of it to buy back some of its debt, and tweaked its credit agreement. Let's unpack all that, shall we? First up, Snap sold $1.5 billion worth of senior notes. Think of these as IOUs that Snap is giving to investors, promising to pay them back with interest. These notes are due in 2033, so Snap has quite a while to figure out how to pay them off. These notes were sold to what they call qualified institutional buyers. That basically means big financial institutions, not everyday people like you and me. They're buying these notes under what's called Rule 144A, which is a shortcut in securities law to sell to big players without all the usual red tape. The interest rate on these notes is 6.875%. So for every $1,000 you lend Snap, they'll pay you almost $69 every year until 2033. That's a pretty decent chunk of change. It signals where debt is in the market a bit expensive. Now, why did Snap borrow all this money? Well, mostly to buy back some of its older debt. They're basically refinancing, like when you take out a new mortgage to pay off your old one, hopefully with better terms. But it's not just about the interest rate. Sometimes companies buy back their own debt to reduce the amount of debt they have outstanding, which can make them look better to investors. It's like saying, hey, we're serious about paying down our debts. Speaking of debt, Snap also made some changes to its revolving credit facility. This is like a company credit card that they can use to borrow money when they need it. They extended the expiration date on $800 million of this credit facility to 2030. This gives Snap more breathing room and access to cash if they need it. However, there's a catch. Snap now has to maintain at least $800 million in cash and cash equivalents. This is a liquidity requirement, meaning they always have to have that much money on hand. It's like a minimum balance they have to keep in their corporate checking account. This amendment to the credit agreement also says that Snap didn't have any outstanding loans as of February this year. So while they have access to this line of credit, they weren't actually using it at the time. The notes that Snap issued are governed by something called an indenture. This is a legal agreement between Snap and the trustee, which is US Bank Trust Company. The indenture lays out all the terms and conditions of the notes, like the interest rate, payment dates, and what happens if Snap defaults or fails to pay. The indenture also says when Snap can redeem or buy back these notes early before March of 2028, Snap can redeem the notes at a price that includes a make-whole premium. This is basically a fee they have to pay to compensate investors for the fact that they're not getting all the interest payments they were expecting. After March 1st, 2028, Snap can redeem the notes at a set of prices laid out in the indenture. The price probably decreases over time the closer you get to the note's expiration date. Snap estimates that it will get about $1.47 billion after paying the initial purchasers, like Goldman Sachs and JP Morgan, their fees and expenses. They used almost all of that money to repurchase those older convertible notes we mentioned earlier. The plan is to use the remaining money for general corporate purposes. That's a fancy way of saying they could use it for anything they want, like working capital, operating expenses, acquisitions, or even more buybacks. The indenture also lists a bunch of events that would be considered defaults. If any of these happen, the trustee or the note holders can demand that Snap pay back the notes immediately. These events include things like failing to pay interest or principal on time, breaking agreements in the indenture, defaulting on other debt, or going bankrupt. So basically, if Snap gets into serious financial trouble, the note holders can come calling. If Snap goes through a change of control, like being acquired by another company, they have to offer to buy back the notes at a price equal to 101% of the principal amount, plus any unpaid interest. This is a protection for the note holders, ensuring they get paid if Snap gets bought out. The indenture also includes covenants, which are restrictions on what Snap can do. These covenants limit Snap's ability to create liens on its assets, guarantee other debt, or merge with another company. These are all designed to protect the note holders and make sure Snap doesn't take on too much risk. All that stuff we just talked about regarding the indenture and the notes is legally a direct financial obligation, which means Snap is on the hook to pay these debts. Snap repurchased a whole bunch of its convertible senior notes. These are special types of debt that can be converted into stock under certain conditions. Snap bought back $45.3 million of the 2026 notes, $797.4 million of the 2027 notes, and $800 million of the 2028 notes, costing them around $1.445 billion. Snap is reminding everyone that this report contains forward-looking statements, which are basically guesses about the future. They warn that these statements involve risks and uncertainties, and that actual results could be different from what they expect. Now let's step back and take a broader look at Snap. Snap's debt juggling act is interesting. On one hand, refinancing debt can save money and provide more financial flexibility. On the other hand, taking on more debt always increases risk. They have to now pay 6.875% of the $1.5 billion they owe. The fact that they are buying back shares, while a nice signal, is not great. Snap has struggled to become profitable and grow, and this is potentially not a good use of resources that may have been better allocated in reinvesting in the business. So where does that leave Snap's stock? Looking at the stock price, Snap is trading at a valuation that reflects high growth expectations. However, given their recent struggles to achieve profitability, those assumptions are likely to be wrong. It will be hard for Snap to justify its current valuation in the future. Given the risks and uncertainties, I'm leaning towards a slightly bearish outlook on Snap. There is too much pressure with the debt and other underlying fundamentals. I believe a reasonable price range would be $10, $12. Thanks for watching. If you found this helpful, please subscribe, like, and leave a comment below.